I'm Taylor Vick, and this is the Real Estate Fund Insider. We're pulling back the curtain on how to grow wealth and passive income through real estate investment funds. So today we have Josh, the CFO of Lima One, who I guess if you're in your office, you're like a block from here. But
That's right.
The way the schedule's worked out, we're doing it on Zoom today. So Josh, glad to have you here. You know, Josh and I went to Clemson together. I think we were both in Charlotte, coming up in the finance world around the same time, and both ended up in Greenville. So Greenville, besides being a great spot for real estate investing, a lot of other great stuff going on here. Josh, why don't you tell us a little bit about your background and about Lima One?
First off, I'm really excited to be on. Thanks for having me. You guys do a great job with this podcast. I watch clips and shows quite often whenever it comes across my register. So good to be here. Yeah, and so my story is maybe a little unique. I went to Clemson, like you said, and went to Charlotte and worked at B of A after that. And the way I got to Lima One was because I had met the founder of the company. His name is John Warren, almost by chance. Back when I was in college, he didn't go to Clemson, but he had gone and served in the Marines, come back, saw this gap in real estate investor financing, and started this company called Lima One. Lima One is actually the call sign of John's Marine company, and so that's the legacy of the name.
Yeah.
And I just knew that I wanted to be part of something more entrepreneurial. I had always worked really since high school in some form of banking or corporate finance. I know I look like I'm still in high school, but in this industry for a little while. And so when he came to me and told me what he was doing, at that time, this was 2012-ish, it was still a very nascent industry. There wasn't any large, reputable financing companies that were focused on this space. But I just happened, because of my background and some of it just because I believed in the individual, to know that this was a business that could be built and be really successful and be really large. Maybe not as large as it ended up being, but at the time, I just felt like it was the right place for me to be, felt called. And so I burned the ships proverbially to go from Charlotte at B of A and move down to Greenville. And kind of the rest is history. I was a sixth employee. We got just under 300 employees today, and we continue to grow the franchise and really make it something special and powerful.
That's awesome. Yeah, I didn't realize you were the sixth employee. That's awesome, man.
Yeah, they didn't have many choices then, right? So, that was all they could hire. It's been a great run. We've been fortunate. We've hired a lot of really good people. I mean, it's been a great time to start this type of business, albeit we didn't have very much capital. So I'm not really sure why we decided to start the most capital-intensive business possible without much money. But
I remember when Lima One was coming up, it was, back then, if you wanted private financing, that meant you got to find an old dude who'd been doing real estate investing, for the past 70 years. And now he's got a bunch of cash and he'll give it to you at a ridiculous interest rate, but he'll give it to you for whatever you're doing. He'll give it to you.
Do you have a pulse? You're good.
Yeah, exactly. Do you have a pulse? Give me first lien position. I'll finish this flip myself if I have to, because I've done a million. Yeah. So you guys, came in and kind of filled, just like what you were saying, you've got banks lending at 4%. Then you've got, old Mr. Real Estate lending at like 20 or 25% once you calculate the effective rate with, 7 points up front and all that stuff. So, you guys really came in and filled a gap. So, talk a little bit about how Lima One's evolved, because it's not just what we call in the industry hard money lending, which is essentially money given to people to flip a house really quickly. That's really high interest rate, or at least was before people like Lima One came in. But tell us more about how you guys have evolved and how you're different than like a bank type lender.
It's a great question. And so you really nailed it. When we started in this business, it was almost completely unbanked. You got to remember, this was still somewhat shadow of financial crisis. And so people, especially banks, were not really willing to touch these types of high risk, rapid turn loans. Previously, you had some community banks who were doing it, but certainly none of the national banks. And so we came in and said, it's like, all right, this doesn't seem like a well-served market, because, we're competing against Mr. Country Club with, a slush fund that he can lend out because he knows the asset and it's in his neighborhood or whatever. Well, for us, we just felt like that was exactly the type of competition that we wanted. And we knew we could business. Nothing wrong with those guys, right? Like they're super fast and they serve a role. So there's a place for it. But that whole like hard money connotation was something that we wanted to get away from. We wanted to bring an institutional flavor, but still preserve some of those things that help investors be successful: speed, ease, control, transparency, relationship. People really understand the business model that they're operating. And so for us, we said, all right, well, if we're going to come in and we're going to play that role, we need to do a couple different things. One, we need to make sure that we're what I call functionally integrated. And so that means we've got real systems, we've got real people from the point that we shake your hand at a meeting or the point that you get a marketing email, all the way to the point that your loan pays off. We're servicing that loan, we're processing that loan, we're underwriting that loan, we're doing the construction management, so we're releasing the draws. And what that enables us to really do is, one, operate with speed, but two, just give you immediate feedback. And yeah, it might not necessarily be as easy as the guy checking your pulse and writing you a check, but that we're going to be there when you need it, and we're going to be able to scale, right? Like that was a business model that could scale. So from our perspective, we needed to prove out the systems and the process. And once we got that track record, that's when we were actually able to expand beyond just the traditional sort of fix and flip loan. And we started adding other loan types to our arsenal. So today we still do rehab lending, but we do construction lending, we do rental lending, we do multifamily lending. And so that's really enabled us to widen the breadbasket and serve a lot larger variety of clients with a much larger array of business models.
Very cool. And I know you guys, at least for me, you're homegrown, you're in Greenville, but what do you service the entire nation now? You got 300 people.
No, at this point, we're nationwide, all major MSAs, except Alaska. It's too cold up there. But yeah, we started, it's interesting too, a little bit of the lineage. When I started, we had just moved to Charlotte. Like we expanded our geographic footprint to Charlotte, and that was huge because at the time we were only in Atlanta and Greenville. And so it was pretty fun and awesome to see the footprint expand over time. Actually, we used to have a map, like a United States map, and every time we do a loan in a different geography, we put a pin there.
Oh, yeah.
We've now lent essentially in every major US state, a major MSA, and have kind of expanded our footprint. We're still, I would say, predominantly in the East Coast, but we've certainly increased our presence out west as well.
Who's kind of the ideal client for Lima One? I mean, I can talk to my experience, doing the residential fund. You guys were a great fit for us because we were trying to aggregate a lot of different, single family assets that were in different places. And, you bring that to a community bank and it just kind of breaks their system. They just don't quite get it. Where it's like, we're not buying houses, we're buying investment real estate, and it just is not all in one place, And so they're trying to put it in a single family box, and they can't put it in the commercial box, or they put it in the commercial box and the commercial people are like, what, this stuff's all over the place, or, so for us, you guys being super familiar with the asset class that we invest in, that was unique because, again, you talk to the banks and they just don't even know how to start with it. So I know that, people like me, people who are aggregating a lot of different SFR type assets are a good fit. Who are some other, people that you serve really well?
Yeah, I appreciate that feedback. So it also goes a little bit to the question you asked earlier about like, how do we compare to banks? What role do we play? We'll see, like that speaks to the exact problem of a lot of banks will lend on rehabs, construction, or rental property, but they don't specialize in it. And it's amazing how much better service you can deliver when you become an expert in the type of collateral that you're lending against. And it's not just sort of a side pocket business. And so then kind of to answer your question about like who our client is any real estate investor who, one, values the same things we value, which is a relationship and which is building a growth portfolio in the long term. Now, I know that some of the loans that we do are shorter term in nature, but we're not trying to be transactional. So I want to do business with people who we're going to do business with for 10, 15, 20 plus years, because that's how you build a long-term sustainable business. At least that's how we think about it. And I think that's also a little bit different than kind of the past. This business was always just like, it's a trade. How many transactions can we get done? How many loans can we get done? Who knows whether or not this will still be around in 5 years, next housing crash or something to that effect. So I think it's that. I think it's also somebody who really is versatile in their business model. And what I mean by that is, the way that any of these asset classes changes over time, I think has been pretty rapid and will continue to be, will move quickly. And so what we see and our best clients and best operators, like they adjust, they're agile, they move their business model quickly. And that's kind of how we as a firm measure our DNA. It's like, can we be responsive to those needs? Because if you just want to come to me and you truly just want the absolute lowest rate, I tell you, go find a bank. But if you want somebody who's going to be able to help evolve and grow your business right there beside you, and when you need something that we don't even have today, and I mean, you and I have had these conversations. I mean, hey, what do we not offer? What do you need that's not out there? Like, that's the fabric of our business. How do we create solutions and financing options that don't exist today, or improve the ones that we have? Because we recognize that these businesses are businesses. It's not just, you buying a house. It's not lazy. I mean, these are active investments that are being made, and we've got to operate at the speed of light in order to really serve our clients well. So a little bit of a long-winded answer, but I hope that gives you a flavor for just how we think about our client set, which is wide, but it's also sort of narrow in the sense that we're looking for sort of the right state of mind and cultural fit as well.
Yeah, I think you said something really important there. People, I don't know why, but people call real estate a passive investment, which I don't think so. I do real estate investing. I have 10 employees and we invest in real estate. So if it was passive, it would take 10 of us to do it. But I think that's a great point that you guys get that, and you're involved and active within the relationship with the borrower too. One thing you mentioned is you guys are agile as the market changes. The market's changed a lot in the past year. You and I go to some of the same conferences, and it's just funny, like just how people themselves act differently as the market's changed, especially this past year. What Blue Ridge has been doing is we're continuing to pursue, high value type investments, value add type investments. As we've seen interest rates increase and cap rates not change much, that means we can't really just buy things like we had done a lot in our previous funds, just for pure cash flow. We've got to go out and find the really good deals and add the value to really get the alpha from the investment. What are you guys seeing investors do now that's creative, and how are you guys moving with them, serving them?
Yeah, so you make a really astute observation about like how those things have changed.
Yeah.
At these conferences 5 years ago, these sort of industry real estate investment, no one ever even talked about things like build to rent, right? Like that was a totally new concept where you get a tract of land, you do all the development, you throw up houses, and now it's quote unquote horizontal multifamily. And so, what that is really, in my view, a symptom of is exactly what you described. Like it's harder to just buy right, off the MLS or even off the market. Like the cap rates are just tighter. People have sort of gotten the joke, and there, you do have some level of, I'll say, excess liquidity coming in trying to, buy rent-ready properties, for example. The huge value add, no pun intended, is in those opportunities to upfit, renovate, and then essentially transition into longer term loan products. And so a lot of the savvy, smart guys like yourself have also noticed that. They've been, kind of, they're always one step ahead, right? Like you guys are always one step ahead. And so what we've done, which is kind of consistent with who we are as a lender, is create more, I'll call them transitional products that allow you to buy properties that maybe have some deferred maintenance. We'll either give you the rehab fund if you want them, or you can do it out of pocket. But once you get it stabilized, then we're doing the longer term refinance at really competitive rates and fees, and just making it all seamless. Because that's important in today's market. I mean, one thing that we consistently hear from clients is like, hey, it's just hard to see 12 months in front of us. We can probably see 3 or 6, but given that, like, I don't necessarily want to lock in the terms for 3 years. But I would love to do something where we can get enough certainty in the near future, but then have that optionality once perhaps the sky's clear a bit. I just think that's really important, and something that we've been really focused on is how do we help clients who are doing those exact business models, because I think you've probably heard this stat, it's like 75% of houses in this country are more than 30 years old. And so huge amount of, I'll say, obsolescence that needs to be dealt with by our exact client base. And so for us, we just want to play right into that, whether it's rehabbing or even building. we just think that's a place where you can really make a return on your dollar today versus, to your point, in the past, you could go buy any rental house as is and, get a great return on it. That's just not quite as much there these days.
Yeah,
Still there, but it's not quite as much there.
exactly. We talked about SFR type stuff. What other asset classes do you guys lend on? I think multifamily, right?
Yeah, multifamily is a big one, and it's right into the belly of the curve of there's not enough housing in this country. There's especially not enough housing for affordable workforce units. And so our multifamily business really targets that subset where you call it 60 to 80% of average median income affordable, but the units are affordable to that demographic. And it's typical stories. Our sponsors coming in and they're buying an asset that's got some level of distress, needs units to be repaired, upfit. We're providing the acquisition financing and the renovation financing. It's literally called our value add multifamily program. We've seen a ton of volume there and a lot of interest. The multifamily stats even worse in terms of deferred maintenance. It's like 80 or 85% of multifamily complexes are 30 years old or older. So it's really pronounced, and there's a lot of need for renovation and upfit in the small balance multifamily.
So, we talked a little bit about kind of how the industry was, right? It was really, country club, old, lifetime real estate investors who were lending out cash at really, really high interest rates because banks couldn't do it. Lima One was formed, really formalized, professionalized what it meant to get a loan from someone besides a bank. I know larger investors like private equity have begun to basically funding some of these lenders. There's even a public market, a CMBS market for these types of loans now. So this industry has evolved insanely fast from basically completely 100% localized, non-institutionalized to it seems to be almost fully institutionalized. What does the future look like? I mean, I think there's a long runway left for non-bank lenders in this space. What do you guys see in the future?
Yeah, it really is amazing how much things have progressed. And we talk a lot about it on sort of the product front, where literally when I joined, we had one product and now we have all these different products, right? But it's come even further from the financing standpoint. I'll just share a quick anecdote. I mean, for the first 5 years of my career here, I've been here almost 10 years now. The first 5 years, I mean, it was nothing but capital raising. It wasn't even really capital raising. It was just trying to explain to people what it was that we were doing. Yeah. And after probably a couple of hundred closed doors, I don't know if we just said it enough, people started to get it, or there were other people starting to come in too. But yes, suddenly institutions, when I say institutions, I'm talking about Wall Street, money center banks, institutional, asset managers, money managers, insurance companies. And then what happened is there suddenly was not only sort of a financing market for it, but there's also a secondary market for it, like bond investing market. It was unheard of to sell a bond that was backed by rental property loans or fix and flip loans.
Right.
Even a couple of years ago.
I still have trouble believing it. I mean, it's incredible.
Yeah.
Incredible how quickly it happened.
Yeah, and I'm grateful for it. Don't get me wrong, but it has definitely, been very fast paced how much it's evolved. And so where I see that going, then it's almost like, everything that we have today could be very different 6 months from now.
Oh, that's a good point too.
Yep. Contour. But, I think the first sort of big chip that will fall. So you start just doing unrated deals. Rental deals now are rated. So I think that's a really important change and upgrade. I think we're going to actually start seeing what's called residential transitional loans. Let's try to say that 3 times fast, but that's basically your bridge multifamily, your construction loans, and your fix and flip or your rehab loans. That's how those are sort of qualified in the capital bond markets. And so those deals are now all done on a private basis. I think there's some potential in the next, call it 6 to 12 months, that you could actually see some rated deals come out. And when that happens, now what that's going to do is collapse the cost of funds for lenders like us to then go deliver that back to clients. And suddenly, even today where a construction loan might cost you 9 or 10%, that could go down to 7% or 6% if you were able to get your cost of funds lowered with that type of rating. I mean, obviously the overall rate environment's got to come down a little bit too, but just to kind of give you a sense for where I think it's going is it will eventually get like true institutional acceptance in the form of rated fix and flip construction and multifamily bond deals.
Wow. So let me try to say that back to you. I think if I can say it, maybe the viewers at home can understand it too. Basically, what you're saying is, first to explain kind of these, the bond concept or CMBS, commercial mortgage-backed security, people like Lima One are making these loans and then essentially putting them into a financial security that can be sold to investors essentially as a bond. So they, pay money and they receive interest payments just like you bought a bond, right? And those interest payments are made by the people paying their mortgage, the investor paying their mortgage, and it's like, it could be 100 or 500 of them. And then you said rated. So when you say rated, you're talking about credit rating, right?
Yeah, like S&P.
Like S&P 500. And so I guess the important thing there is, when something's unrated, it's considered junk or, trades at a high interest rate. If something can get, what's called an investment grade credit rating, that means, hey, this is this good investment. You do your diligence, but it's not too risky, especially compared to something that's rated junk or is unrated. So I think the implication for that is huge. I didn't know that was going on. Has anything been credit rated yet, or is that something you're saying is kind of in the works right now?
So if you look at the bonds that have been issued that are backed by the rental properties, those actually have been rated. Wow. And not only does it sort of give the stamp of approval of these are really high quality assets, but it also opens up your investor base because a lot of institutional investors, as like they can't buy unrated bonds. And so, it's not even just a cost of funds, it's also a liquidity thing. And so what hasn't been rated yet are these residential transitional loans, which included in that category is construction, the multifamily, and the fix and flip loans. So like today, if you were to buy a bond that was backed by those types of loans, it would be unrated. You would have to, as a portfolio manager, ascribe a higher level of risk, which means there's a lower price that you can pay or a higher interest rate that you have to get in interest payments in order to invest in that bond. And so all that's to say, if Standard & Poor's says, okay, now we're saying that this is investment grade rated. Well, you as a portfolio manager can suddenly get a lot more confidence in that. And obviously, you might have needed to get paid 8% on that bond, but with the S&P rating, you might be willing to get 6% or less on that bond just because of that sort of stamp of approval. I probably need like a flow chart or something.
It makes sense to me. If it makes sense to me, it probably makes sense to everybody else too. So. Yeah, that's exciting stuff. Okay, so we've said the word interest rate a lot, or rate. Why don't you talk about what's going on with interest rates? It's still a hot topic these days. So how has the increase in rates affected your business? What do you guys see happening in the next year? How are you guys helping investors in this higher rate environment?
Awesome. Yeah, that's a great question. So we're not immune to interest rate increases. Anytime the Fed bumps up their Fed funds, like that directly impacts our cost of funds. So you think about what the Fed's doing. I mean, they're tightening around the quote unquote risk-free rate. So, and we're not a bank, to be clear. So we don't get to borrow. And even if we were a bank, we're not getting to borrow at the risk-free rate. So that's sort of our baseline, right? So if the baseline is at 4.5%, then we've got to borrow above that because our lenders aren't going to allow us to borrow at the risk-free rate. And so like as that notches up, that's going to continue to increase our cost of funds. What was tough last year is it just went up so fast. I mean, the pace was breathtaking. I mean, it was historic. And so like that was really challenging for us and our clients to just reset. I do feel that we've probably reached, I won't say an apex, but at least a little bit more stability. Like I just don't expect to see such rapid increases. Maybe I'm not saying anything particularly noteworthy there because it was truly historic what we saw last year. But I do expect us to be in this general rate context for the foreseeable future. So what I mean by that is cost of funds are on average about 300 basis points higher, anywhere from 300 to 400 basis points higher, and it depends a little bit on the product. And that has a big impact on people's business model, right? Like you have to underwrite your cash flows differently. You've got to build in more margin in what you're doing to sort of absorb that increase in the cost of funds, especially on the longer term stuff. And so what we've tried to do to help offset that a little bit is offer a lot lighter prepay penalties. And even now we're the first that I'm aware of, at least, that has a no prepay penalty option. So basically what it says is like, hey, Taylor, look, I wish my rates were lower today, but like I can only go so low given where the rate environment is. But here's what I can do for you. I can give you the best rate possible today and open it up. So, if you believe rates will be lower in 2 years, that's great. You can go refi and no prepay penalty for you. And, we'll still be friends because I'll be the refi whenever you go.
That's right. That's one thing that we're targeting now is, long term with maximum prepay flexibility. So we want to get that term in there because, hey, rates may still increase. So we want to make sure we got a long term. However, we're not going to do that unless we know we've got the prepay flexibility in case rates go down, which hopefully they will. So that's awesome that you got a no prepay product. Generally consumer loans, everything's prepayable at any time without a penalty. But that's very unique in especially non-bank commercial lending, where you typically have make whole provisions, or if you're CMBS, direct to CMBS, defeasance, and all these crazy expensive things.
Yield maintenance was one that a lot of people were rolling with a couple of years ago, where you're paying, if you try to pay early, you're literally paying essentially the interest from the point that you pay all the way to maturity. So you got to be careful. Like that stuff really can impair your optionality. I talked earlier about making sure that we give our clients as much optionality as possible. It's like from your point of view, right? Like, what do you want? Of course, you want the lowest possible rate and fee, but you also want to make sure that if you can get a lower rate and fee, you also afford yourself that benefit if it arises. So we get it. Like we think like operators. A lot of us, we've been in the business a while and have our own sort of approaches to it. And so we definitely get the perspective of our clients, or try to at least.
We don't need to talk about duration or negative convexity or bond math here, but how is that product? Is that still being securitized with the prepaid penalty? And I guess my experience in lending is if you get one thing, something else goes up. So if you get, better prepaid terms, the rate goes up, or maybe the fee goes up, or if you have no fee, you have higher rate. Kind of how does it balance out there? And is that a product that's funded by bond sales, or kind of how does that part work?
Yeah, your intuition is right. There's no free lunch here. And, that product is more expensive than if you just had the full level of prepay. Mm-hmm. So you almost have to have a view on, you think rates are going to be, some percentage lower in the future. Now, I don't think it's personally, in my sort of pricing assessment, I don't think it's for the option that it affords. I think it's priced very well, but the reality is like these loans get priced similar to our other loans, where either we're financing them on balance sheet through one of these sort of money center, large bank warehouse / aggregation facilities, and or we're financing by issuing bonds. And so, yeah, you do have to think about what the implications on that is. Obviously with no prepay penalty, you're going to have more prepay faster, which if you're a bond investor, it's like I want the bond to pay me interest as long as possible. And so if I get paid early, that's net negative to me. So if you have less prepay protection, I'm going to charge you more on my interest. And so it's one virtuous cycle. But I think what's unique about how we approach it and how we think about it is it's like our job is sort of to match, like, how can I deliver you a solution that balances what you need with also what the capital markets, bond investors, and others are going to require. And our job is sort of to thread that needle and create a solution that matches those demands. And, I think we've done a good job on this particular feature, but on others as well. And so it's, and it involves, it changes too. Like that math changes weekly. So what it costs today might be different than what it costs tomorrow. But I do think it's a really good feature to have when we are in this type of environment where there's a lot of volatility.
Yeah, absolutely. And, I may or may not talk to your competitors sometimes, and I haven't had one tell me there's no prepay. I'm still seeing yield maintenance out there.
Yeah.
I'm seeing 5, 4, 3, 2, 1s. I know with you guys, we've done 3, 2, 1s before. That was awesome flexibility that, that worked really well with the strategy. we were pursuing. So, that was really great for us. And I know it was good for you guys too. So what's one thing that you wish that all real estate investors knew about lending that would help them be more successful?
So what I would say is I always try to think about our business the way that our clients think about it. And so when I talk to our clients today, like they are much more sensitive to building in extra margin in what they're doing. And so the way I then think about that is, okay, well, unfortunately, as a lender from the lending position, my upside, so to speak, is somewhat capped, right? Like the maximum I'm ever going to make on a loan is the interest rate and the fees that I charge, which is fine, right? That's the business we're in. And that's why we're not lending at 100%. And that's why our clients have equity in the deal. But I think it's important to keep that in perspective if you're a client and you're trying to understand, like, why in the world are they asking for this or that? It's almost always going to be coming from the lens of, all right, well, my only situation where this is a win for me is if this loan pays off in full. And so that's probably why I'm going to be more interested in your credit score, your experience. That's probably why I'm going to have an inspector look at construction draws before I just release the funds. And, it can be a little bit more onerous, certainly not as onerous as a bank, but also, in my view, worth the trade-off to have another hoop or two to jump through when you know that, okay, once that relationship is established, you can grow your business model, you know exactly what to expect, and you can essentially continue to borrow as much as you want to borrow to scale your business in the way that you want to scale it. So I would just say that because like I know it's always, at least the comments that I'll hear sometimes, and by the way, like I'm not assuming that we're the only people who this comes up with, but it's like you talk to clients and the lender's always the worst person and they don't get it. I mean, by the way, like, again, this is not just Lima One specific because I am intentional about surveying the entire audience. And there's more often than not a reason for those things. So just keep that in mind and be nice, I guess.
Yeah, exactly. Yeah. It's what keeps rates low, right? So
Yeah, no, seriously, that's a good, like, it's so much easier for me to offer super low rates when I can vet your experience. Like I can price to that. We always say we're about price and risk. Well, for me to be able to price that risk effectively, I got to understand it,
yeah, the
or
knowledge.
else I default to sort of a higher risk price. So,
when people complain about, banks asking for more stuff, blah, 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 all that stuff. Or I say, well, they're putting more money in it than we are. You got to get in perspective sometimes. And I think, it's easy to lose perspective because there's so many lenders and so many banks, and it's kind of just like, you should just give me the money. But really, look, the lender's putting in more money than I am. And I'm trying to make a 3-bagger on this deal, and you guys are trying to get, 5%. So, yeah, it's worth it to give you 5% of my 300%, even if that means it's a little bit more paperwork. So obviously I'm in this business full time. So we've got everything organized, generally where whatever you guys ask for, we've already got it teed up. But yeah, I do try to remind people sometimes, hey, yeah, it's frustrating, but that's why the rates are low. That's why the terms are good, because they're fully vetting it out to get the best rates possible.
I appreciate that levity. I may ask you to hop on a few calls with me.
Sure. And credit officers are great people. They're just, they're the best people on earth.
What I will say, and this is truly a difference, right? Like we are common sense, and it is our job to explain the reason that we do things. And there are some things that we've done over time that don't make sense. Like just simple example, we used to get tax returns from people who may like, you know what, you're a real estate investor, who knows what your tax return is going to look like. Oh, by the way, we're lending to funds and other sorts of non-standard entities. And so it's like, I'm not saying that everything we do is completely logical, but these days we've got it pretty curated and finely tuned where 95% of what we're doing has a very specific reason and purpose.
So this is maybe this is somewhat of a selfish question too. I know with you guys, I think the loans we did were actually 30-year terms, but it switches to like adjustable rate. I know a lot of loans have like 5 or 7-year balloons on them. What are you guys seeing with people who are coming up to refinance balloons, or their rate is starting to adjust? Are those people getting stressed or de-stressed, or are there opportunities for buyers to look at people who are saying, hey, I like this property at my 4% interest rate, but I don't like it at my 8% interest rate. So I'd rather sell it than refinance it. Like, what are you kind of seeing there with balloons and refinancing now?
It's a good insight. That's definitely coming. So if you think back in sort of the 2000, call it 17, 18 timeframe, like that was the heyday of doing a lot of these like large portfolio loans, more like your commercial style. So, one loan, dozens or hundreds of properties attached to it. And so almost all of those were done on 5-year balloons with yield maintenance. And I don't have the exact number. It's in the hundreds of millions, if not billions, of loans are coming up to maturity off of those terms. Yeah. And so there's going to be, reckoning maybe too strong of a word. There's going to be they didn't underwrite those deals right. Yeah, they're not going to work, and they're going to be forced to sell or forced to look at some other creative solution. So, shameless plug here, but another thing that we really try to advise, for lack of a better word, is like, don't take the balloon risk if you don't have to. I mean, we've got a 5-year IO with a 25-year AM. Like, you can still get the IO sort of cash flow benefit without having to take that balloon risk. And, it's unfortunate because I'm sure we and others were saying that 5 years ago, but, you look at the shiny low rate and sometimes that just wins no matter what. But yeah, there's going to be some people who are trying to figure out what to do with large portfolios that are at 4% that are now looking at 8%, right? Like, that's just going to happen.
That's something that we're trying to monitor and see what opportunities might be there. I think, for assets that we have that are coming up on maturity, between principal pay down and asset appreciation, we can increase the amortization to lower the debt constant or try to keep it the same as it was before. But I know other people, they may not quite have that opportunity or the rate increases. So
you guys were smart too, right? Like you did AM, so you've been paying down principal. Oh, by the way, you've had HPA, so you pay down principal and the property's worth more, so you got a ton of equity. So yeah, you're going to have a lot more options. But there are operators who don't have as many options.
So if someone wants to get in touch with Lima One, wants to talk about loans or the services that Lima offers, what's the best way for them to reach out or get in touch?
Yeah, I'll give you like my personal phone number, and we can post it up on the screen after this. No, we've got a tremendous website. It's great virtual real estate, www.lima1.com. Start there because it's got all of our contact information. Also, it's got a way that you can apply or at least do an inquiry to hear some terms or just learn more about the company. I mean, one thing that I do encourage people, we will tell you what your exposure limit is or what your potential guidance line could be without charging you anything for it. So even if you're just curious, it's worth going on there and reaching out and trying to find more about what you might be eligible for and or just learn more about our products. We do have sort of a variety of things that might be interesting to a variety of different investors. So that's where I'd start, www.lima1.com. These types of conversations are what really makes this industry awesome. It's one of the more relational businesses that I've ever been a part of. And it's something that I just think we all get better if we had these types of conversations and learn from each other. So I'm just honored to be here and looking forward to spending more time with you.
Real estate's always been a relatively friendly community, especially in the single family SFR type world and small multi and things like that. People willing to help each other out a lot. And so it's kind of cool now that we've got lenders who are, like you said, kind of there too. When it's all banks, they're just, they have all these rules and regulations. But people like Lima, you guys can pivot like you talked about. You're right there with the investors. You understand what they need. You can shape new products. You guys can kind of customize stuff a little more.
Yeah, I didn't do any gymnastics on screen, but I do feel like we've got a lot of agility for a lending institution.
Thanks for joining today. Good to have you on as always.
Thank you, Taylor.